Why TLT is showing the bond market understands terminal rate might be 6% to beat inflation. TLT lost 1.68% on Friday, followed by a 2-day losing streak right after the Fed policy meeting on Wednesday. Meanwhile, oil price hit a bottom in September and started to go back higher again. It actually went up 20% from the low of September to now in November. What does this mean for the October inflation number, which we will get next Thursday? I did notice that the gas price is higher now than back in September. Is it just the Halloween effect or something else? The stock market went up in October too. Look at the Dow. It went up almost 15% in October alone. Even Bitcoin has recovered from the 18K low in September to now at 21K. People are fighting the Fed. Why TLT is showing us the bond market knows the Fed will raise to 6%, potentially in 2023. Let me explain all the mechanisms right after this. And of course, smash the like button. If you want to be my good boy, apply to write your first book with me. Welcome back to the Audacious Money Witch channel, where we talk about macroeconomy, stocks, bonds, and commodity markets. If you like any of these topics, you are intelligent. That's why you're here, and you know what to do, and push my button if you like what you see in today's video, because I can't push it from this side. This video is brought to you by my Patreon. If you are a good boy, go to patreon.com/magicalgoddesscheryl to add more meaning into your life. If you play your cards right and completely submit like my good boys do, then I will take you under my wing, author of best-selling books, Goddess Cheryl. My good boys always get rewarded handsomely. You are such a good boy. You like hearing that, don't you? You want it to be real. You want to be true. You need to be my client, don't you? The Federal Reserve lifted interest rates by another 0.75 percentage point to combat inflation and signaled plans to keep raising them, possibly in smaller increments, but to higher levels than previously anticipated. The increase approved Wednesday. The Fed's fourth consecutive 0.75 point rate rise lifts the central bank's benchmark federal funds to a range between 3.75% and 4%. After the decision, Chairman Jerome Powell said officials would contemplate a smaller hike at their next meeting in December, but he cautioned that they might raise borrowing costs next year more than they have projected. The question of when to moderate the pace of increases is now much less important than the question of how high to raise rates and how long to keep monetary policy restrictive, he said on Wednesday. Chairman Jerome Powell also warned that reducing the size of rate increases didn't mean the Fed thought it was close to pivoting away from raising rates. It is very premature to be thinking about pausing, said Powell. We think we have a ways to go. The bond market was on the same page here. The hope for a policy pivot at this meeting seemed quite misplaced and obviously proved to be so. But the bond market was not looking for any sort of pivot. at their September policy meeting. Most Fed officials projected that they would need to raise the benchmark rate to around 4.6% early next year. Officials didn't release new rate projections Wednesday. Chairman Jerome Powell said that if they had, they would have been higher given recent strength in the labor market and high inflation readings. A higher path for interest rates suggests a greater risk of a recession, he said. The inflation picture has become more and more challenging over the course of this year. Without question, he said, to the extent rates have to go higher and stay higher for longer, it becomes harder to see the path that avoids a recession. Investors in interest rate futures markets expect the Fed to raise the Fed funds rate slightly above 5% by next spring, while Chairman Jerome Powell said he didn't think the Fed had raised interest rates too much. He repeated his view that it would be appropriate for the central bank to err on the side of overdoing it rather than underdoing it, because he saw a bigger cost for the economy in allowing inflation to become entrenched. Officials are boosting interest rates at the fastest pace since the early 1980s to reduce inflation that is running near a 40-year high. They have raised rates by 0.75 point at 4 consecutive meetings. The latest rate increase will bring the Fed funds rate to a level last seen in the first 3 weeks of 2008, as the economy was sliding into a deep recession. And before the central bank accelerated rate cuts as a global financial crisis was unfolding. The Fed combats inflation by slowing the economy through tighter financial conditions, such as higher borrowing cost, lower stock prices, and a stronger dollar that curb demand. The Fed funds rate influences other borrowing costs throughout the economy, including rates on credit cards, mortgages, and car loans. Changes to the anticipated trajectory of rates, and not just what the Fed does at any meeting, can influence broader financial conditions. Fed rate increases this year have hit asset prices and are causing a significant slowdown in rate-sensitive sectors of the economy, such as housing. The run-up in yields on the 10-year Treasury, its largest 3-month gain since 1984. The average 30-year fixed mortgage rate in October rose above 7% for the first time in 20 years. Before this week's meeting, some officials had begun signaling their desire both to slow the pace of increases soon and to potentially stop raising rates early next year, to see how their moves this year slow the economy. The Fed's policy statement, released Wednesday, pointed to how rate rises slow economic activity and inflation with a lag. The danger of continuing to raise rates by 0.75 point is that by the time those lags reveal themselves, if you keep going up by 75, you've done a heck of a lot more than you really wanted. While the central bank will need to see evidence that inflation is coming down decisively, Chairman Jerome Powell said he had never thought that several months of slower inflation data was the appropriate test for slowing the pace of increases. His comments opened the door to slowing rate rises as soon as December. though he said no decisions had been reached. He also said the Fed was not close to stopping rate rises and holding rates steady for a while. We think there is some ground to cover before we meet that test. Powell said, while domestic demand has slowed and the housing market is entering a sharp downturn, the job market has remained strong and inflation pressures have stayed elevated. Recent earnings reports have shown strong consumer demand and pricing increases. But the strong job market, a generous savings cushion boosted by world crisis relief, and steady gains in asset prices over the past few years could keep consumer spending robust, giving businesses more power to keep raising the prices. Fed officials are also nervous that tight labor markets could fuel persistent wage growth that boosts prices in the labor-intensive services sector. That could keep prices rising on everything from haircuts to car repairs to hotel stays, even as prices fall for cars, furniture, and other goods where they have surged last year. I don't think wages are the principal story of why prices are going up. I also don't think that we see a wage price spiral, said Chairman Jerome Powell. But once you see it, you're in trouble. So we don't want to see it. And that is why the Fed must keep on raising the rate and tightening. Now you know why the bond market understands the Fed and the stock market just waiting for the right time to go down. VIX is waiting for the right moment to go up. China's lockdown and zero case policy is here to stay. Chinese official just reiterated on Saturday. It's so silly to believe the rumor and the market manipulation on Friday. Hang Seng Index's rebound is according to the chart. It's based on technical. Hong Kong stock market has fallen over 50%. Now they are bottoming. I think the art of investing and trading, you need to respect the change in the economy and the chart. Learn to pivot and pivot quickly. Even Buffett makes investing mistakes. I admit I bought TLT too early. Being early is almost like being wrong. At least it feels like it. When the government policy change, you can't just sit in one camp forever. A lot of people only sit in deflation camp like Cathie Wood, Steve Van Meter, and Harry Dent. Don't ever take anyone's word as trading or investing advice. Be careful who you listen to. Your money is your responsibility. You can't have deflation when the oil price is at 90, when government don't allow people to drill oil. You can't hope the oil price will fall magically. Another lesson is from Peter Lynch, he said. Don't ever try to predict interest rates. If you can do it, you are a billionaire already. Okay, I'm going to show you my client Lee Vincent's book, The 3 Most Important Influencers You Need to Meet. Such an amazing book. And my client Teddy Eazzy's book, he's such a good boy for working with me. This is his book called Wicked Pussy Perfume. It's an erotic novel. Such an awesome book. Order your copy today. And this is my very first book, Treasures Within Our Heart. It's my very first book out of 40 books. And last but not least, my Time Awareness and Secret Millionaire book. You are such a good boy for watching my video right till the end. Bye.